Hi, I'm Nick Harris, and I'm here today to talk to you about the telecommunications sector and a couple of companies specifically being Telstra and TPG that reside within that sector. So if I start by talking about the sector and then I'll move on to the companies. So from a sector level, you may recall we've been saying for about the last 18 months that we've had really irrational pricing coming through in the sector. The bird's eye view is that over the last 5 years in particular, the NBN has been gathering steam. More and more customers migrated off their legacy networks and onto the national broadband network. And what that's done is created price pressure. So everyone's competed very aggressively on price to get or keep customers, and that's pushed returns down. Naturally, that flowed into mobile, and naturally, now that we're towards the end of the national broadband network rollout, it's starting to normalise again. So the good news is we're starting to see rational price movements in the sector. So to be more specific, if we look at the mobile sector, the three operators, Telstra, Optus and TPG, or Vodafone as the brand you may know, all three of those operators have actually increased their mobile prices in the last 6 months. So that's really good for the sector as a whole, not so good for consumers, but great for telco investors and the sector as a whole. It's a lot easier to grow your earnings if you've got revenue growth. So we think that's certainly a positive. And then the second thing is, obviously, when it becomes easier to grow your earnings, investors are more interested in investing in businesses with earnings growth, so we would expect the share price to follow earnings higher. If we now move on to the company-specific side of things, I'll start with Telstra. They reported their result in mid-August. It was a good result from Telstra. For the first time in a very long time, it was a very clean set of numbers. It all added up, and you could get the momentum in the business and see where the business is going and get some comfort around their key target, or aspirational target as they call it, for EBITDA of greater than $7.5 billion in FY23. Now for retail shareholders, that's really critical because in order to hold the dividend at the current level on a sustainable basis, Telstra's repeatedly said they need $7.5 to $8.5 billion of EBITDA and effectively a return on capital of greater than 8% in order to hold that dividend. And we've now got a pretty good path to see how they get there, and you don't need to make heroic assumptions to get there. So just to recap on the result, number one, it was a good clean set of numbers from Telstra. Number two, they delivered underlying EBITDA growth from the first half to the second half. So underlying EBITDA growth for the first time in many, many years. And a key highlight of that was actually the mobile business growing EBITDA. Mobile business in Telstra is more than half of the earnings of the business, so really critical that that grows to grow the rest of the business. Number three, they held the dividend, and it was more than comfortably covered by free cash flow. Number four, they have provided guidance for that underlying EBITDA to grow again in FY22. And then fifth and finally, look, we've got that clear path, which is all important to that sustainable dividend. So we can see how we get where we need to be with Telstra in order to hold the dividend. In terms of the next data points for Telstra, there's actually quite a few. It's catalyst rich over the next 3 to 6 months. Firstly, they will be hosting an Investor Day in September. Secondly, they'll have their AGM in October. And it's also expected that before the end of this calendar year, they ask shareholders to vote on the legal restructure, which splits Telstra effectively into 4 different business units. So there's news flow to come. And catalysts that should also help the stock re-rate in addition to the underlying fundamentals improving. Now, I also wanted to make a comment on TPG Telecom, who also reported a result. It's been one of our key picks for about the last 6 months. Stock came off a very long way when the founder left, and also, I guess, on an absence of information. A lot of investors were concerned that earnings in this business were going to fall in a heap when the founder left. Our view was that was not the case, that it was actually a buying opportunity, and we're feeling pretty pleased to see that the EBITDA delivered at this result was pretty much in line with what we were expecting. So EBITDA is really the proxy for cash flow in this business. We saw the revenue and the EBITDA come down just a little bit year on year, but we also importantly saw it grow half on half. So our argument has been that it's got relatively stable earnings, that this year, because they are a December year end, so calendar year 21 is also their financial year, this year will be the trough, and we can see a number of reasons we should see that earnings improve in the outer years. But the key thing is earnings did not deteriorate dramatically. They actually paid a much better dividend, almost double what we expected, and the cash flow in the business is expected to be very strong again for the full year, even though there were some timing issues in the first half. So effectively what you've got is a good business with earnings that have troughed. And if you look at Telstra versus TPG, the free cash flow yield on an apples for apples basis, the free cash flow yield for TPG is nearly double that of Telstra. So we still maintain that it's the best buy in the telecommunications sector, and we think it's a highly attractive and very comfortable with the result following the TPG first half result. So in closing, sector's getting better. We're happy buying Telstra, we're happy buying TPG. Thank you.